All right. Good morning, good afternoon, good evening, wherever you are on this beautiful planet. Welcome to the Inner Circle Live pre-New York session. I'm your host for this morning's session, Benny Allen, along with my awesome partner, Mr. Ryan Carthage. And we're definitely happy and grateful for each and every one of you being here with us this morning as we take a look at the technicals and the fundamentals to see what we could take advantage of in the Forex market. So, without further ado, let's make sure that we turn off any and all distractions. Grab a pen and paper, take lots of notes. And as always, let's make sure that we participate and engage right out the gate this morning. If everybody can hear me loud and clear, do me a huge favor. Drop me a one in the chat. Let me know that you are with me. You are ready to go. I see the good mornings. I see the ones coming in. I appreciate it. Appreciate all of you being here with us this morning. And we want to make sure, right, that we take massive action each and every morning, right? That we are understanding and accepting all possible losses before entering a trade, preparing you for any outcome, right? We win the war before it begins, right? By we start right with making sure that we're comfortable, right? And I'm sticking to this point because it's very important that we are comfortable with any loss, right? Before we actually take that trade, meaning that what we set stop losses. Okay, so we want to make sure that we center ourselves in body, mind, and spirit, ensuring a balanced approach to trading, and that we trust in our education, strategy, trading skills, and intuition. We want to make sure that we imagine our trade successfully materializing and that we are obeying our trading strategy, avoiding decisions based on greed and fear, and that we are never looking back or stopping once the trade has commenced. So we are almost crazy, right? Almost at the halfway point already in September, right? Into the fall. Okay. Last month of the quarter before we move to Q4. And yeah, we've got a lot going on. So we are going to start out with the fundamentals as always, right? To see what we're looking forward to for the day. And the big thing today is that we have ECB, right? Decision coming up. Okay, got the ECB. Let's see. That is from 8:15, right? So before 8:30, 8:15. And then right behind that, we've got core PPI coming through for the United States, along with the unemployment claims. And at 8:45, the ECB press conference, right? We'll see if we can get that link posted right in the community so people can hear what President Lagarde has to say, head of ECB. And then you also at 10:25, you have Chairman Jordan from the Swiss National Bank speaking natural gas storage, right? Uh, we've got some notes. I believe that was from Joy, right? In the posting all types of good notes and things. I'm right on saying that. Make sure I'm correct on that. Joy, is that you, right? Posted that in the community on natural gas. Yep, yep. Uh-huh, uh-huh. Couple good articles, right? On bonds and things like that. So natural gas storage report coming out today, right? So if you're looking at natural gas as a commodity that you're trading, you want to pay attention to that. So pretty busy day. And then we move into Friday, which is light. Look at Friday, right? No red folder. So today is the day. Yesterday, September 11th, right? We had a core CPI come through month over month. It's a smidgen high. Forecast 0.2% came through at 0.3. CPI month over month remained flat. Year over year, right? The key number forecast was 2.5, came in at 2.5, down from 2.9%, right? So we are looking for that rate cut for sure. We just from the Fed, it should go to 25 or 50. We shall see. We shall see, right? So a lot of talk around that, right? If you listen to any podcast, or listen to Bloomberg Radio, or any of the, the financial shows, a lot of speculation around whether there's going to be 25 or 50 basis. So we will see again trading economics, right? ECB to reduce interest rates for a second time. So if you're in the Euro setups, know that you can get some volatility starting at 8:15. Okay. Swedish inflation rate decelerates to 1.9%. So that's good. Okay. It's starting to come down globally. German wholesale prices dropped the most in 4 months. China's 10-year bond yield hits a fresh historic low, right? So we were talking about bonds yesterday. Joey posted some info regarding bonds. Okay, an article on that. So make sure you read that if you get a chance. Australian inflation expectations ease slightly. Okay, slightly. Right. So we know inflation has been sticky. Okay, so we'll continue to watch that with uh, the Australian dollar. Also, looking at the moving over, looking at the quant, right? Coming into the day, we're mixed. We're mixed, but for the week, right? You guys can see we've come from that risk off situation to moving back over. For the weekly, been slightly risk on, but today we're mixed, but it's ahead of major data, right? So anytime you come in early pre-market and you got data occurring, major fundamentals, a lot of times you get um, that mixed signal. Okay, so that's where we are there. Any questions regarding the fundamentals? No. So Joy, let me ask you this, right? Based on the articles and things you're reading, just following up on our conversation yesterday. So when we talked about interest rate being in the environment where we get interest rate cuts as it relates to bonds. So if I'm looking at a 2-year and a 10-year situation on bonds, and we're looking at possibly in the future, right, major rate cuts occurring, would you be more as an investor, would you be thinking more about investing in the long term, more of a longer term 10-year or a 2-year, considering what could be happening in the future with interest rates?
That was my exact question. And I'm getting to the understanding that for right now, in the short term, it would be the 2 year, and for the long term, it'd be 10. So depending on my technical analysis, what I will be able to pick that off of.
Right. So yesterday we talked, and it was towards the end, so we didn't really get a chance to go in depth on it. So what we did leave off with, just overall, if we're in our yields, right, tend to increase, right, when interest rates are rising, right, because it drives yields higher. Okay, and so typically when you're in an interest rate environment where interest rates are being increased, right, being hiked by the central banks, the bond yield tends to go up, right?
Right, the
And
bond yield
so
go up, so then I will be more risk on because now my money will be working for me, far as being in the stock market. So I will switch my money over.
think about it. Think about it, right? So when you, right, because you have, so going back to your 2-year and your 10-year, right? And you read about this inverted yield curve where the yield curve for the 2-year, right, has crossed over and moving up above the 10-year, right? And a lot of times they say that that could be a sign, right? Historically, a sign of a possible recession, right? You all follow me on that? Drop me a one in the chat. Right. So just talking about the curve, right? So if I got a 2-year, when we talk about bonds, I got a 10-year, right? Longer, that's a longer duration, right? 10 is longer than 2, right? So you're investing in that bond, you're holding that bond for 10 years, right? So that leaves me open to more exposure to changes in the interest rates, right? Which therefore could impact my yield in a positive or negative way. So if I'm investing, if I see that there's the future that interest rate cuts may be coming, what does that tell me, Enric? What could that possibly be telling me about growth, right? When we talk about growth, we're talking about GDP and things like that. Like you think about economic, right? What does that tell me? If central banks are saying, "Hey, we're in an environment where we've got to cut these rates, especially if they get aggressive in their cuts." What does that tell me about the possibility of growth as an investor? Why am I paying attention? right? What may be the reason behind these rate cuts for central banks in terms of growth? Central bank, right? So when investors look at it, when we look at environments where interest rates may be getting cut, right? Like we're in now, what have we been reading about lately, right? And why we've been seeing dips in the market and things like that. People have concerns about the growth, right? So if I'm looking out 10 years and I'm seeing, hey, there's interest rate cuts on the horizon, right? Because they may be cutting these rates to what? To try to help to stimulate growth, because right now growth is slowing, right? And we know that if we get two negative quarters of GDP, that's a what, right? Two consecutive quarters of negative GDP is technically considered a what? The big R word, right? A recession, right? So when you're cutting rates and you're trying to stimulate the environment, like we just saw here, look, with China, the 10-year bond yield hits a fresh historic low, right? Look, amid setting a new record low amid rising concerns over the country's outlook. You see what I'm saying? So the yield's hit because why? They're gonna cut. They're gonna keep cutting rates, right? They're gonna keep cutting rates to try to stimulate growth. So if my yield is attached to whether or not interest rates rise, increase or decrease, right? If I'm looking at my outlook, 10 years, a 10-year bond, I'm exposed. I'm exposed because now they're cutting rates, and so I may get less. I may get less yield than I originally was getting in the beginning. Does that make sense to everybody? Right? Because cutting rates is going to impact my yield, right? Which is the interest gain. Okay, so if if I buy right a 10-year, right, right at the coupon rate of $1,000 bond, right, bond is $1,000, right? Because even if you don't invest in bonds, right, why do we look at this as one of our right gauges for the condition of a particular economy, right? So I buy that bond at $1,000, right? The duration is 10 years. 10 years. And I originally get it my yield, right, is 6%. Is say I'm getting 6%. Like 6%. Well, over 10 years, if they're cutting rates and say the rate at that point was the federal funds rate or whatnot was 5%, whatever. Well, if they decrease that and they start cutting interest rates because of how bond prices versus your bond yields, how that fluctuates, right? I may, right, making this as elementary as I could possibly make it in regards to the relationship between bond prices and bond, right? So if it's at 6%, oops, 6% or whatnot, percent, right? Now, if we're cutting rates, I may get less yields. Maybe I'm only coming through at 4%, right? Because of the rate cuts. So that tells me that as an investor, that I may not get as high a yield moving through in the future over that longer duration because they are cutting rates. right? They are cutting rates, which there are concerns about growth. Okay, that's why they're cutting rates, is to kind of continue to stimulate. Because why do they increase? Somebody tell me, why do they increase rates to begin with?
Inflation was high.
Right. And so so inflation is high, right? Meaning that there's a lot of, we've got in this current situation, right, that we've had, is that they pumped a lot of money into the economy, right? To what? Stimulate growth. But then that overheats, right? And so we got a lot of money out there circulating, which now, right, the value of our money is worth less. So what do they have to do? If they pumped a lot of money in, what do they have to do now? Figure out a way to do what?
Pull it back.
Pull it back. Correct. And so as a consumer, if I'm a company, a corporation, a company, and if interest rates go up, it becomes more expensive to do what? Borrow money, right? Buy things. So we pump those interest rates up so people can, right, do what? Start to pump the brakes on spending. If I'm a company and it's too expensive to invest, it's too expensive to borrow money to invest, right? I'm less likely to invest, to expand, right? If you own a company and I'm going to the bank because I want to build a new facility and create new jobs and all of that stuff, am I going to do it? Would I be more motivated to do that with a higher interest rate or a lower interest rate? Correct. Correct. Right. And so when you look at people look at that 2 year and that 10 year curve because you're trying to get an idea of how investors are thinking. Sentiment, right? Overall sentiment. What do they think is going to happen in the future? Well, if the feds are moving, central banks are moving to cut rates, right? That means economically, when they look at those economic indicators, like what we talk about it on a regular basis, right? Wage growth, right? Our wage is coming down. What are the employment numbers, right? How many jobs are being created? Well, you start to see a pattern of less jobs being created. When we look at those manufacturing numbers, and you see manufacturing and demand for exports in some countries going down, or demand for imports in some countries going down. If there's all of a sudden they're looking at the numbers and we've got less demand on imports, right? That means that, hey, my citizens who are consumers aren't spending as much. If my export numbers are going down as a country, meaning the things that I produce and we export, right, products and things like that, if the is going down from Europe for my exports, there's less demand. Hey, spending is slowing. That makes sense to everybody? Yes, no? So that's why we look at all of these different all investors are trying to do, traders are trying to do is, hey man, get a glimpse into the future and what could be happening, and trying to think, 1, 2, 3 steps ahead, 5, 6, 7 months, a year, 2 years ahead, right? That's what's going on. That's why when we go over these fundamentals every day, that's what it's not sometimes it's not about the particular report on in that given month. Sometimes it's about a string of reports over time and what's that showing, right? So we continue to see uh, inflation over time has continued to decline, right? It's been trending to the downside. So it's starting to come down. Things are starting to slow, right? we're seeing less jobs, right, being created. You know, when we look at non-farming, we look at the employment data. Today we have you have core PPI coming out, which when we look at this report, so it's the change in the price of finished goods and services sold by producers, excluding food and energy. So the price of finished goods, right? So is the cost to produce things coming down, right? Because if the cost to produce things go up, that is typically passed on to who? The consumer. And you have to spend more, right? To buy those finished goods and services. Yesterday, we had the CPI, right? That came through. Okay. Look, the change in the price of goods and services produced by consumers, right? Purchased, I'm sorry, by consumers, excluding food and energy, right? Because food and energy prices could be volatile, right? So you get a cleaner number if you exclude that. You see? Right. Walmart rollbacks. So, you know, is it increasing? But if it increases, is it increasing at a slower rate than it had in the past? Right? Does it beat forecast? So all of these things, right? Investors, traders, we're trying to tie together to find out what could be happening next. Right? So I may limit, Joy, my exposure to a 10-year, right? To a 10-year if I'm projecting that there's going to be fat and massive rate cuts coming from the Fed in the future, right? And if I'm predicting that those cuts may be coming in the future, why are those cuts coming in the future? Well, one reason why they may be coming is because growth may be slowing down. So there's growth concerns, which is what we've seen going back and forth, right? Over the last few weeks. You guys remember when we had that non-farm payroll that missed forecast by a wide margin and the market tanked, right? We've seen that huge correction because there were concerns over growth. Everybody follow me on that? Drop me a one in the chat. Okay. So that's why we pay, right? And when you go through the training and you look at one of the trainings talks about key things like retail sales. We go over in the training, GDP. Like what is it? What does it mean? These key fundamentals that we look at, right? So tracking it over time. So if you come over to like the quant box and you look at the fundamentals and you look, one of the key things is what? GDP growth, right? You see? Right? So this is for the dollar, right? For the US. And you see how it's tracking it over time, right? So if we go back up and we look at employment numbers, right? You see this, here, 114. See how we were 200 something, right? 200 or something. 140. Look, this one was revised down. This one was revised down. This came in at 142. Will we get a downward revision? Right? So they come through later and they revise to clean the number up. But this here, look, this was 206 for the US. It got revised down to 79. Right? So look at that. Right? Look at this, 517. Right? Look at that. Look at that number, right? So this is what people are tracking over time, right? Jobs openings. How many job openings? Look at that. So there are growth concerns, right? We know what it means on the technical chart when we see lower highs and lower lows, right? Wages, right? Creep back up, but you guys can see overall, right? It started, right? For the most part, moving down is below the median. So you guys that's been with us for a while, you continuously you hear the Fed, Jerome Powell, right, speaking, right? In the beginning, it was constantly, right? When everybody was like, man, when are they gonna cut rates? When are they gonna cut rates? But he kept saying what wages are sticky, right? In the UK, you hear him they kept talking about wage growth, wage growth, wage growth, sticky, right? Because what happens if wages are increasing? What do people typically do with their money when they get more money? They spend it. So if you're putting that out there in the economy and you're spending it, right? Good for the economy. When you have good growth, you're gonna see higher inflation. You will. It's just what is the rate of inflation? Is it accelerating at too fast a pace, right? Which is what we have, right? So it's also about the pace in which inflation is increasing, right? And so you have to figure out a way to cool that down, right? So when you heard you know, Jerome Powell talk last time, he said what? It's appropriate. It's now appropriate, right? We're now in a position where we can start cutting rates, right? And so it's a fine balance. Don't want to do it too fast, right? Don't want to get out the gate too fast. But sometimes it's hard to determine, right? What's too fast, what's too slow. Like it's hard. It's a hard job. Okay. So that's why these numbers are important, right? Are very, 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 very important to pay attention to, right? So we look at central banks, okay, and you can see, look at the forecast coming down, right? So if we look at the dollar, right, you can see, look at the projections, Q3 moving into Q4, Q1 of 2025, right? We've got rate cuts, okay? So that's why you keep hearing people say, can the Fed can they orchestrate a soft landing where we can actually bring interest rates down without it having too heavy of it? Like, can we bring it down, right? Can we get through high inflation and then eventually bring inflation down to where we don't have a deep recession? Can the Fed pull it off, right? Because if you remember, a lot of people were projecting a recession a long time ago because people thought that's what was going to be needed in order for things to come back into balance. It hasn't happened yet here in the United States. We haven't had the two consecutive quarters of negative GDP. We have it in other parts of the world, right? But even those were mild considering what it could be or what it could have been, right? So, right, wanted to make sure that we cut. Does that help everybody?
Yeah, dude, because the other night, if you go to risk analysis and then money market, it goes over the 2 year analysis, yeah, for each
Uh-huh.
of the what's the name.
Uh-huh. Right. So they go 2 year with the 8 day. But and this is gold, right? to looking at the 2 year with gold, right? So people have different data points. So when you think about like when you have a lot of times this is how they brand themselves, like different hedge funds, different investment groups and things like that. Like when you look at if you're an investor, you're going to invest the money. You can go and kind of look at, hey, how do you go about this, right? What's your model, right? What models do you look like? How do you determine engage, right? What the market could do, right? To put probability in your favor, right? So here you got the 2 year versus gold, right? So people look at different different things, different models that they build out to help them to make decisions from a global macro perspective, right? If that's their model of how they go about things as investors. So each firm can be different. Each individual investor is different on what they look at to help them determine where they're going to invest their money quickly, right? So that's why all of this, these things are important. All right. So I wanted to spend some time going over that today. Because I thought that was important coming off of the conversation that we had towards the tail end of yesterday's session. We didn't really get to go in detail about it, right? So your duration, to wrap it up on bonds, Joy, your duration, right, is just really like a measurement, right? So 2 year tenure of how sensitive a bond, you know, is the changes in interest rates, right? Okay. So the longer the duration, the more sensitive your bond becomes. Okay. All right. Ryan, good morning, sir. How are you?
Benny, good morning, bro. I'm doing well, man. How about yourself?
Oh man, doing pretty good, man. Doing pretty good. Always glad to be here with you.
Yes, sir.
Yep,
Appreciate that breakdown, dude. Um, Definitely gives with a lot more clarity to the situation.
for sure. No problem. Anytime, man. Anything on the fundamental front that you're paying attention to? This morning, anything with the yen?
Um, I'm gonna go early this morning, but nothing additional right now. I'm trying to get some more insight on the BOJ and where they are. Um, if there's anything else that comes out regarding their decision coming next week, but nothing additional right now.
Got it. Got it. All right. All right. Extremely helpful. Thanks for always being there. Yep. Appreciate it, JC. Appreciate the feedback. All right. And if you guys like, hey man, like, I'm still a little bit confused. Can you help me? Like, it's like, hey, send us a message. Send us a message, right? We help you out. Okay. So looking at the DXY. Okay. So you got a little bit of a bump, right? So on this 4 hour, we've been watching this little 80-20 zone play out. We're still struggling here. Okay. We're still struggling here. And oftentimes everybody the dollar, we know that the dollar, right, is the world's reserve currency. It can be tricky at times because sometimes things may not be so favorable for it domestically, but it still can find strength at times because it can also act as a safe haven. So if the market goes risk off, sometimes it just depends on why the market is risk off, right? And the dollar may benefit, you know, from some of those reasons as to why the market sentiment is shifted to risk off. So we have to, because the dollar, right, again, is the world's reserve currency, right? And so when you talk about like the credibility and the overall, strength. So if a lot of people move money, say in a situation, people moving money into U.S. bonds, right? You can see the dollar strengthen, right? So, but you have to have U.S. dollars to invest in those U.S. bonds, right? So it just depends. So we always have to figure out the why behind it. Okay, so that's where we are. But back up at that level, right? Holding steady there. We'll see what happens with the data that comes out today because we do have U.S. data coming out. Um, but that's where we are. All right. Taking a look at, let's move over ahead and take a look at some of our indices. Yeah, and so we look at the S&P 500, right? And we got a bit, right, of a bump, a rally back to the upside. 80-20 play, you turned in our buy zone. Okay. So we're getting a rally. So if we come over and we take a look at let's take a look at the US 500, right? We can see US futures held steady. This is Thursday after a tech-led rally on Wall Street in the previous session, fueled by the release of the August consumer inflation data. In regular trading, on Wednesday, the Dow rose 0.31%, the S&P gained 1.07%, and the NASDAQ composite rallied 2.17%. Semiconductor names including NVIDIA, AMD, Broadcom, SMCI, and Taiwan Semiconductor, this is right, led the charge. Other mega cap firms like Apple, Microsoft, and Amazon also posted gains. These moves came as data showed headline prices eased to 3-year low, but core inflation came in higher than expected. This fueled speculation that the Fed will opt for a smaller 25 basis point rate cut at next week's meeting, with traders reducing their likelihood of a 50 basis point cut to just 15%. On the political front, the presidential debate raised chances for Kamala Harris' victory, boosting solar stocks while pressuring crypto firms. That's funny. But right? Green energy, right? Green energy. So crypto firms, pressuring crypto firms. Somebody tell me, right? Take a shot at that, right? Why would we get pressure on crypto firms, right? With a increased chance that Kamala Harris could win. But neat. There you go. All right. Regulations. Regulations. Right? Because we know it's been the Wild West with crypto. So at the end of the day, right? We saw gains. We come over, we take a look at the spider, right? And we look at the breakdown, we can see visually what they were talking about, right? We had some gains, right? In those areas. Okay. So, it wasn't, that, sometimes the small news could be big news considering what the sentiment has been, right? So when we see that CPI, right, and how it can in certain areas how it creeped up, right, that gives optimism, like, hey, that it's not as high as it had been, but hey, people haven't completely shut down, right? People are still moving forward, doing what they have, right? So 25. So that's why the market took that as a positive sign. So it's coming down, but not at a crazy rate to where everybody's putting the brakes on everything, you know, and spending is completely slowing at too fast a rate. So 25 basis points is what people are leaning towards, I guess. We shall see. And we see a rally in the stock market. And so we can see that we put in a higher low and we rally, right? That's on the 1 hour. If we come out and we bring this out to the daily, okay, interested to see if that rally continues today. I actually really need that to happen. Okay, and I do have some positions where I bought a little bit too high. Right, but you can see here on the daily, we clearly have put in another low right here on the S&P. And so, hey, we're not getting a 50, getting a 25. People are going to view that in different ways, but at the end of the day, the cuts are coming, right? And so just building off the conversation that we had, like, hey, interest rate cutting environment, we saw that, hey, the spending has not slowed too much. So, hey, so now it starts to subside just a little bit in regards to, if we're going to see some declines in growth, maybe it's not going to be a crazy, ridiculous decline, right? We're just slowing a little bit, right? We're just slowing a little bit, and the Fed is cutting rates. So now that's a good balance for us to keep it moving, right? Good balance for us to keep it moving. So now we're feeling a little bit more confident, feeling a little bit more risky, and we're gonna get back and we're gonna come out of cash and put some more money into these stocks, right? So that's right how it goes. Look at your Nasdaq. Looks familiar, right? This stuff is tradable, everybody. It's tradable. Looks familiar, doesn't it? You all see that pattern? Yes, no? The market moves up, down, and sideways. 80-20 correction to the buy zone. Right? Let's see what happens, right? Okay. Now, we have these drawn up as C to D moves, right? But we know that just this move alone, right? That gets you paid. Okay? That gets you paid. So, right, we move up to the daily, right? This is the lower in which your rally started to move. Look at our stochastic. Look at where we are on the daily. So do we get a continued rally from here? Right? The market responded positive, in a positive way, right? Everybody was looking for everybody. The forecast for jobs, came in at 142, but that was up from the revised, right? From the I said the revised from the revision, right? Right. So you got to remember that last payroll number got revised down to 89, right? This is up 142, right? Up to 142. Okay. The forecast was 164. But even though it missed forecast, it was still higher than the revised numbers from the previous month. Okay. So it's still showing, right, some growth there. And then everybody was waiting on the CPI data. And now we'll look at the PPI data that's coming up to see what's going to happen and see if we can get a continued rally, right? I hope so. I hope so, right? Here's your UK 100. Right? This is kind of doing this thing, right? We didn't get a deeper pullback, right? But we're just moving sideways. Really, we're having a problem at this resistance level, right? So we didn't pull back as deep. I was hoping we could get back to that weekly support, but that was kind of moving sideways. That was not as clean. Um, Here's the Russell, right? Okay. So can we get a continued rally off the lows? Okay, so it's your Russell 2000 there, right? Right there yet on the daily, right? That second candle to the right. But we got a pretty good, right? You guys study candlesticks, okay? That's pretty nice there, right? Can we get a continued rally? Possible bear 15 80 20 XPX range. And let's go back and take a look at it. And we'll go down to the 15. Right at that level too, huh? Drop some sevens in the chat. JC. Good job. I like that's nice. That's nice, right? So if you didn't catch that initial rally, right, you got an 80-20 that could come back down, right, and give you another low on the lower time frame. That's really nice. Let's see what happens. Okay. Be patient. Know that we have data coming up. Right? We've got PPI data coming up. But we're struggling at that level. And we know we love it when we've got key structure in the area of our sweet spots. So let's see how that plays out. Nice. Thank you. All right. Here, right, looking at the German 40, looking at that pull back, right? I don't know if anybody was looking to play that. I didn't play the trade this. All right. We're trying to recover and rebound, but that took that out on the 4. All right. Let's move up to the daily. That's a deep correction. Right. So you got it on the counter move, but then it continued to take out the move down and take out the A there. Right. Right. But this is the broader picture, right? So if we get a rally, boom. Right. There's your low. Right. Wait for that to confirm today. But is this going to be, is this low going to hold, and do we continue long from there, right? All possible setups, by the way, all right? If you're trading off that daily chart. Okay. Looking at, this is, so, whew, said we had a tech rally, right? Semiconductor ETF said the rally was led by tech. Look, see how this all comes together? Semiconductor names like NVIDIA, AMD, Broadcom, SMCI, and Taiwan Semiconductor led the charge. Right. Led the charge. That's the charge.
I ain't gonna even lie. I'm looking at all of these and they all look like teacups because I was looking at my. So I think they thirsty and they want to run.
What'd you say?
They thirsty, so they about to start running.
Let's see. Right. I am a big fan, right, of this tech space and this SMH. So, right, pull it all together. NVIDIA, AMD, Broadcom, SMCI, Taiwan Semiconductor. So if you look at the breakdown of SMH, you can see that it contains, right, NVIDIA, Taiwan Semiconductor, Broadcom, Advanced Micro Devices, NVIDIA, AMD, right, Broadcom, SMCI, Taiwan Semiconductor, right? So we saw this move to the upside. Make sense? Drop me a 2 in the chat. All right, let's go, Forex Trade Room. We got this, right? We got this. Okay. Moving up. That was the rally, right? We take advantage of those. Okay. We take advantage of those. Look at commodities. Okay, we're looking at oil. Hey, we said, hey, we got an 80-20 play. Huge bearish candle. Couldn't completely move through that zone, right? So now we're recovering. Right. So if anybody's playing that, be right slightly in profit right now and see if we can get a continued move to the upside. And let's see what's driving, right? Touch and see if we can see what's driving that. Right. Rose around 68.3 per barrel on Thursday, extending gains from the previous session as supply setbacks from the Gulf storm outweighed ongoing demand concerns. Supply and demand. Okay. Supply and demand. Here's GDX, right? This is a gold ETF. We talked about this, right? And how we've got that low being put in. And right now we're holding in that buy zone. So do we continue to move higher from here, right? All we can do is draw it up and run the play, everybody. All we can do is draw it up and run the play. We're either gonna be right or we're gonna be wrong. Okay. So that's one of your gold ETFs. Taking a look at nat gas, right? Starting to push. I know Jeremy's holding it long in that gas. Been in it for a while. Right. Big kudos to Jeremy. Anybody else that's taking that nat gas trade, right? If you're holding it over the long term because of the seasonality, because of the demand, right? See it continue to move up. Julie posted some really, really good notes in the Forex trade room community, right? So make sure you read up on those. Right. If we push through that resistance, we're gonna keep it moving. Right? Keep it moving. So let's see what happens on that gas, gold, right? Right. Kind of still hovering in that same area in our quest, right? For 2600. Our quest for 2600. Let's see if we're gonna get there, right? It hasn't been doing too much. Right. So let's continue to follow and see where that goes. Any questions on commodities? Didn't cover silver, right? So we saw that U-turn. All right, pretty much double bottom and move back up. That's a crazy price action there. Right? That's on the 1 hour. On a 1 hour chart. Move out to the daily on silver. Clean this up. Work within the same chart. So clean this downfit there. Okay. So we got a pullback. That's in a decent position. Continue to move long, right? So what's the deal, right? Silver climbed towards 29 per ounce, extended recent gains in the lead up to expected interest rate cuts from major central banks. All right. Of course, we got mixed right economic data coming out of China, as well as trends in renewable energy sectors, which utilizes silver in solar panels. Raises chances for Kamala Harris victory, pressuring the dollar, which has been supported by expectations of more tariff and increased fiscal spending under a potential Trump presidency, right? Okay. And we talked about, right, how that, right, for green energy, right? If Kamala Harris wins, right? So more regulations for crypto, possibly, right? Good for green energy, solar, right? Renewable energy sector, which utilizes silver in solar panels, right? The more knowledge and understanding you have, the better. So we can see it. Will we continue to see silver increase because of the demand? Any questions over anything that we covered today?
Nope, but it's around the season. People start buying more silver coins around this time.
Seasonality, right?
Mm-hmm.
All right. So I know we covered a lot today, but hey, we can handle it in this group. It's a brilliant group, right? Brilliant group. Ryan, anything before we close out? Nope, I know he's on the move this morning. Well, that is it, right? Everybody keep right. Reminder, okay? Reminder, just around the corner, 8:15, ECB, right? Main refinancing rate, monetary policy statement. Then she comes back, right? President Lagarde comes back at 8:45 for the press conference. So all about the forward guidance, right? The reason why they're for their current decision and trying to get an idea of what they may do moving forward, right? And then in the United States, we've got core PPI data. We had CPI yesterday. And we also have unemployment claims here in the United States. So appreciate all of you being here with us this morning. Enjoy the rest of the day. And don't just count your pips, but indeed count your blessings. Have a great day, everybody.